Hello everybody, welcome back to Steamboat Real Estate and Investing, your inside track to real estate and intelligent investing here in Steamboat Springs, Colorado with me, your host, Ryan Cox. Today, we are going to talk about more of a global topic. We're going to talk about the One Big Beautiful Bill, a massive piece of legislation signed into law July 4th, 2025, just over a month ago. No matter where you land politically, this bill has some eye-opening changes that could directly impact your real estate decisions. Joining me today is Logan Marienau, president of Marienau Tax Accounting, a trusted local firm that delivers timely, accurate, and actionable tax advice to business owners and individuals throughout Steamboat and the Yampa Valley. Today, we're going to dig into the return of 100% bonus depreciation. This is a really big deal. New SALT deduction limits, and we'll talk about 1031 exchanges and cap gains thresholds, as well as a myriad of other tax topics. Whether you're eyeing luxury ski home or multifamily investment property, this bill introduces tools and opportunities that you want to have on your radar. Let's get straight into the podcast. All right, welcome back everybody to Steamboat Real Estate and Investing. Today I am joined by Logan Marienau, president of Marienau Tax Accounting, LLC. Welcome, Logan.
Thank you for having me.
Yeah, you're welcome. Thanks for being here. Today we're going to unpack the One Big Beautiful Bill. Now, regardless of your political affiliations, there was a lot crammed into this bill, and specifically as it pertains to this show, a lot of pieces of legislation that affect real estate, and they may affect the way you view your real estate portfolio, building out your real estate strategy for 2025 and the coming years. So Logan is going to help us unpack some of the key elements in there. So I guess leading in with that, Logan, what do you think the 3 or 4 biggest items coming out of One Big Beautiful Bill are that the listeners might be interested in from a real estate perspective?
Yeah, for sure. So from a real estate perspective, the 3 main ones is bonus depreciation is still there. It's no longer phased out. It is 100% bonus depreciation, and it's permanent. We'll get more into it, but it was going to be phasing down to 40%, then 20%, and then it's gone. But it is back up to 100%, and it is permanent. One other change is the SALT, the state and local taxes deduction you can take off your personal return. It has an increase from $10,000 to $40,000. We'll get more into that as well, but another major change there. And the last couple that aren't really changes, but they're still players in the real estate world, the capital gains. So for the personal residents, second home residents, we still get the $250,000 and $500,000 exclusion for capital gains exclusion.
Okay.
And then the 1031 exchange is still in play. It hasn't gone away, so it's still a tool we can utilize for tax planning.
Great. Yeah, I think that's one of significant interest for a lot of the listeners and anybody really plugged into the real estate space with a commercial approach, renting properties, etc. So look forward to digging into that, but starting with bonus depreciation. So from my research, and correct me if I'm wrong, bonus depreciation was introduced in 2002, widely expanded by Trump in his Tax Cuts and Job Act in 2017, and then of course expanded again here in the One Big Beautiful Bill passed just over a month ago. 100% bonus depreciation. Talk us through what is that? What does that mean? Mm-hmm. Let's educate the listeners on depreciation, bonus depreciation, cost segregation, any of those elements that are intertwined.
For sure. Yeah. So just depreciation in general is taking an asset. So for real estate purposes would be, say, a residential property. You depreciate that, which means you're only be able to write off so much of the value every single year. For a residential property, it's 27.5 years. You have to write that off. For commercial property, it's 39 years. Bonus depreciation, if it meets certain requirements, then you can write off a certain percentage. So it's back up to 100%, so you can write off 100% of that part of that asset in that year. Mm-hmm. It was like I said earlier, it was coming down to 40% this year, and then 20%, and then gone. So, but it's coming back up to 100%, and it is permanent. There's no more phase down aspect of that. But yeah, so bonus depreciation, it is typically any asset that has a useful life of below 20 years. So your 5, 7, 15-year property will be able to utilize bonus depreciation. Typically within the business world, it would be vehicles, machinery, equipment, things like that. On the residential side or commercial side of real estate, it would be improvements to the property, And mainly for bonus would be the non-structural aspects of that property. The one key factor that will help with that is getting a cost segregation study that from a reputable firm, and typically they're done by engineering firms, accountants, CPAs, things like that. They'll break out the entire, for example, the residential rental property, they'll break out the entire property into different pieces. And what's structural, okay, well that is the normal 27.5-year depreciation schedule. And then what is other factors like land, can't depreciate that unfortunately, but other things like the faucets, interior doors, the other non-structural aspects of that property can then take a different
Accelerated.
You can accelerate it, yeah, and it has a different life, and it accelerates faster. So anything below that 20-year mark then can become clumped into the bonus depreciation and written off in that first year.
And the IRS has basically, correct me if I'm wrong, but a depreciation schedule where they've defined all of these things that have less than a 20-year lifespan. Mm-hmm. So, and that's basically all the components of a house, right? Mm-hmm. Like flooring, carpet, doors, windows. So anything that has less than a 20-year lifespan is eligible.
And the lifespan is all related to the tax code. I mean, in real life, it could be a completely different.
Sure.
It's the lifespan.
Based on the tax code definition.
There's two different definitions there. But yes, the definitions on the tax code, the lifespan of that particular part, that particular asset of that sub-asset, will have a different rate that it depreciates at.
Okay. So under the 2017 Tax Cut and Jobs Act, as you said, that was stepping down in 2025. I think you said we're at 40%.
Yeah. So it was 100% prior to this big beautiful bill. It was at 100%. Then it dropped down to 80, then 60, 40, 20, and then it's gone. We're down. If this bill didn't come into effect, it would have been down to 40, and then 20, and then gone. That's what 2025 would have looked like. For 2025, though, it is permanent. It's for anything that was placed into service January 19th, 2025 and after. It's for residential property. It's ready to rent. Yeah. It's ready to go. It's ready for the customer, basically.
It could be, I think, for a lot of the listeners, who may have a second home that's a short-term vacation rental, or maybe it's a 30-day plus vacation rental, long-term. Basically, it could be the day you purchase the property if it was, turnkey and ready to go.
Yes.
So what you're saying is if somebody bought a property after January 19th, 2025, they are now eligible to utilize leverage that 100%. If they bought it on January 10th, they're at the 40%.
That's a good question. That is a good question. I'm not quite sure about that 40%. That overlap right there. I know for sure that after the January 19th, it is 100%.
Back to 100%.
Yeah. You may, might be a research thing, but that may be true where January 1 to January 18th it's at that 40%.
In that crossroads.
And then after that is 100%.
Okay.
But yeah, it is, the closing date of a property is on, a 19th, 20th, whatever after, then if it's ready to go, there you go, right? Yeah. Right then and there. And this is just for investment properties. Personal homes, things like that don't really go into that scenario.
Okay, so you could ask your accountants if you did purchase a property in between January 1st and January 19th. You can double check on that. And then great place to jump to next. What properties qualify for this? So again, we've got a lot of folks that live out of state and they have a second home here that they, there's some commercial aspect to the property, whether it be a short-term rental or, with the passing of the short-term overlay map. Of course, a lot of properties have been excluded and aren't eligible. So I'm seeing, we talked about this on one of the last podcasts, we're seeing more of these 30-day rentals. So it seems to be like anything, short-term, long-term, single-family, multifamily, condo, it doesn't matter if there's a commercial aspect to the property. If it's being used commercially, then it's eligible for 100% bonus depreciation. Is that right?
Yeah, so it's income producing.
Income producing.
Yeah, so investments, rentals, things like that, commercial, residential, retail space, warehouses, things like that, all the way to short-term rental, long-term rental. It is not your primary resident type of scenario. That type of is in that bonus depreciation. Again, let's say you qualify for become a real estate professional, you can include your vehicles. Those again get into the bonus depreciation.
Okay.
Any equipment you use that's excessive kind of price point, but you can take bonus depreciation on that as well. So yeah, it is the income producing property for residential purposes.
Got it.
And then again, it's with the combination of tax advice from your tax advisor, using a cost segregation study, and various other tools that will get you to the ability to take the bonus depreciation. It's not all. Bonus depreciation is not the answer for every person.
Sure.
And so it's not one size fits all kind of scenario.
Sure. Okay. And now cost segregation, just digging in on that again, basically that's a third party that you'd go out and hire, and they're effectively going to analyze the property, put together a pretty comprehensive report, hand that off to you or your CPA. In many cases, people handing it off to you, and then you're using that to incorporate into the overall tax filing. Or that's informing.
So it's always good to have these third party, especially with this and 1031 exchanges. It is definitely important to have that third party. Typically, they're engineering consulting type firms that do these cost segregation studies. They're not cheap. But that report is the kind of the backbone of your case for taking this depreciation in that given year. It is that supporting documentation that is really necessary, and it's key that it's done by a professional. You don't really want to do a shotgun approach with this on your own. It is something that could potentially backfire. But and again, it is expensive. But if you have a property that is expensive or it's high income producing and you're trying to reduce a lot of that income and with depreciation, it may be worth it. So you just got to look at the scenario. What is it? Is it really worth it for me to do it or not? And then again, maybe bonus depreciation, cost segregation study is not the route to go. Maybe I don't need to do bonus depreciation. Maybe I need the depreciation for later years with, say, Section 179 or just normal depreciation. So the scenario is completely different for each individual, each company.
Sure. It can be a useful tool and part of the overall tax strategy for a year. If someone's got multiple streams of income and had a big year, that might be where you do want to leverage the bonus depreciation because I believe, and correct me if I'm wrong, you can create a loss within that company. Let's say it's an LLC owned single family home that's rented. You can create a loss, and that loss can flow up to your personal tax return to offset other incomes. Is that right?
Yeah, to a degree. So there's a couple different things there. So you've got you have active income and passive income, and rental properties for the most part, unless you qualify as a real estate professional, is passive categorized. And so you can, based on other limitations, income being one of them, you can only deduct up to $25,000 of passive income against other income. If you have let's say you have other passive income and then have passive losses, those can offset each other. So you can still offset them, they just can't go. There's only a limit on the
how they can be applied across those different buckets.
A lot of times, if you're in a high income area and income bracket, I guess, you're going to be phased out of those abilities to take the $25,000 limit. Doesn't mean you lose it. It just carry forward to the next year until, let's say, you sell the property and things like that.
Yeah. I think that's a really good distinction, and everybody's CPA or tax advisor is going to have a position on how that loss can be applied, depending on your occupation, profession, et cetera. There's a lot of criteria I think that they use to determine, well, can you take it as an active loss, or does it have to be taken as a passive loss?
Yeah, I mean, calling yourself a real estate professional, you have to meet certain hour requirements, certain time commitment, things like that. And so, really, if it's just you, you just have a job and you have like a 1 rental, 2 rentals, you're gonna have to. This is very rough, but you're gonna have to spend more time doing the real estate stuff than your actual full-time job. And so, a lot of people, unless they are, say, a real estate agent or another in that world, then they don't normally qualify for that active bit of
active loss.
Yeah.
I think that makes sense.
Yeah.
So there's some other, from what I've researched, and of course you can go way deep into this stuff. I've read some things, and who knows whether it's credible or not, but if you have, say, a spouse who's unemployed and they're spending most of the time working on this property, then maybe there's a path to claiming it as an active loss.
There's potential there, yeah. Like say you're working, not real estate, for example, it's something else, and your wife is at home and she can do all that real estate stuff, then yeah, she spends most of her time. There is ways to go around it, not around it, but to
comply.
To comply and to make sure it works. And it works for your scenario.
Yeah.
These are different tools in your toolbox for your tax purposes. You got your bonus depreciation, you got your normal depreciation, section 179, and then you got the 1031 exchange, but you got to put those all together because sometimes things don't play well together.
Sure.
And so you got to make sure that they're all working together. Ultimately, it is back to what your scenario is, what your goals are, what you can do with your specific idea.
Yeah. I think that's great. So before we roll to SALT, maybe we can run through some rough numbers, and I'll try to project some numbers on the screen here for the listeners. But let's just workshop this concept of bonus depreciation and see if we can get to kind of a real potential outcome to quantify what could this mean for somebody who wants to leverage bonus depreciation. So our median single family home price here in Steamboat's $2 million. Let's assume that land value is $500,000, 25% of the developed property, which it's getting harder and harder to find a $500,000 lot, but we'll keep nice round numbers. So $2 million, $500,000 of land. You can't depreciate land, right? So that $500,000 is off the table.
Yep.
So you're left with $1.5 million of improved.
Yeah. So right off the top, depreciation for in this scenario, the $500,000 can't take the land. There's no depreciation on that.
So that goes.
It's in the value of the property, but it doesn't. You cannot take that part of for depreciation.
Okay.
So it leaves you $1.5 million of the asset left.
Yes.
Normally, let's say I'm assuming it's just a normal residential home that you're going to rent
let's just call it a single family home.
Yeah. So it is then normally is depreciated over 27 and a half years. So whatever the math is on that, essentially 1.5 divided by 27 and a half years. Which is great. I mean, it's fine. But then let's say you want to do a cost segregation study. Okay, you hire a professional firm to do this. They come out, they do all the analyzing it all, and they give you the report. And now let's say 30 or 40%, whatever they come up with, is deemed non-structural. You can actually, it's a lower class life, and you can take bonus depreciation on it. Okay, so then you have 30 or 40% of the 1.5 that you can take off right in that first year. It then leaves, say, I'm really bad with math, which is funny. But we got to use a calculator on these ones. But for sure, let's say you have the remaining. You're
basically at 30%. You're at $500,000, right?
Yeah, I mean then you take that amount for the first year, and then the remaining bit is depreciated over the 27 and a half. So yeah, you could easily take that 30 or 40% of that property in that first year, which could outweigh a lot of that initial cost of the investment and help you get going off the ground and with that investment. So, the specific dollar amounts, I got to use a calculator, but
and of course this is rough. Every property is different. Every cost segregation study is different. But ultimately, I think that there's a kind of a rule of 1/3 that I've read about. Where approximately 1/3 of that improved value or the asset, less the land is kind of ballpark what you can depreciate 100% now with the bonus depreciation. So in this case, we're talking about potentially a $500,000 loss in the year that you purchase or put the property into service, as you said, and that loss can be applied, across your
So if you have other, let's say this is your first rental. Yes, you have a $500,000 loss. You can only take so much, but let's say you have your 3, 4, 5, 6, whatever number of rentals down the line, they are all doing well, producing income. You can offset that income with this loss. Yes. And so, there's so much potential with the bonus depreciation and real estate investing in general, because it's a different bucket of income you get more tax benefits, really.
So that's great overview on bonus depreciation, a very complicated topic, but incredibly potentially useful tool for people with real estate holdings, rental properties that qualify as Logan defined. So some of the other items in the legislation that you referenced, I think, were the SALT caps. Can you explain a little bit about that and the changes there?
Yeah, SALT cap. So it's state and local taxes cap. So it's the cap ceiling. It used to be you could only take $10,000 of taxes to write off on your return.
Okay.
Now it's bumped up to $40,000.
Okay.
This is all on your personal return. So this is mainly your primary and second homes, not your rental or your investment properties. And it's now up to $40,000. It's not. Some states have a lot higher taxes, and so yes, that is a stick, in the mud for those states, and so it helped out with that. It is going to be up to $40,000 for 2025 through 2029.
Okay.
After that, if Congress doesn't do anything, it goes back down to 10,000.
To the 10.
If it goes well, it most likely will probably continue on or do something different.
Yeah.
But it's not the state and local taxes is not just your real estate tax write-off. It's the big one. You have income tax in there. You have personal property taxes. There's usually a very small amount, but it's all the other taxes that get limited to that 10. It was 10 now, $40,000.
Okay.
And sorry, I'm going to piggyback on that again.
That's great.
It's only for people who itemize. So you have to use Schedule A and you have to itemize. It's tough. The average person, most of the people use the standard deduction because it's so high. It's really high, which is great. I mean, you get a benefit for nothing really. But the people that do itemize, they have a lot of the real estate taxes, the a lot of mortgage interest for your primary home. A lot of donations, things like that. Medical expenses over a limit. The people that itemize and be able to take those.
Okay.
Will be able to take that.
And what's the standard deduction then, if you don't itemize?
For joint people for 2025, I think it's around 31,000.
Around 31. So if you itemize with the new SALT cap, you could get up to 40. But if you don't itemize and you take the standard deduction, you're going to get the 31.
If you're joint, married, filing joint.
Joint.
Yeah.
Okay.
And singles.
Okay, so maybe leaving $9,000 on the table, depending on how you file.
Yeah, and you got to also too is like looking at the average home here. It's most likely mortgaged, and so you have mortgage interest on top of that. So if you're really close already on the itemizing with basically the taxes, you most likely have a mortgage on your home and your second home. You're going to be able to itemize most likely, just based off that. But you just got to hit that threshold above the standard deduction to itemize.
Got it. And I think when I was first starting to understand the legislation wrapped into the bill, my initial gut reaction was, okay, the SALT cap is not going to move the needle a lot for Colorado or say Broward County, because we're fortunate we've got pretty low property taxes as compared to say Chicago, Illinois, where $1 million here in real estate taxes, these are just really rough numbers, might be $3,000 or $4,000 in ultimate tax bill. But in the Chicago area, and anybody who's Chicagoland resident can correct me, but maybe it's 10x that. It could be 40,000 there. So it's more meaningful, I'd say, for some states. But it sounds like when you look at all of those, the mortgage interest and other things, it still is relevant.
Yeah, I mean, you could easily have your primary home in Chicago, New York, wherever, like those high real estate tax states.
Yeah.
And you could have your second home here.
Yeah.
You're not getting you're still getting the benefit for having the taxes, to be able to write off the taxes. It's just, say you live in those other states with the high, you're taking advantage of that area there, and then you're taking advantage of if you have your second home here.
That's a great way to break it down, because I think, a lot of property owners here in Steamboat are that. They live elsewhere full time and have second homes here. So for those folks, it's very relevant and a very helpful increase. And for 2024, what would have the standard deduction been in 2024 for joint married filing joint? Do you know what that is?
I can't remember the exact number. It's graduated up, so it's just a few $1,000s less.
Okay.
It's just adjusted for inflation. So I mean,
okay.
Oh gosh, I can't. You don't quote me.
Yeah.
I was like 20. Yeah. I think it's like 28,000 or something like that.
Got
it's
it.
one of those.
Okay.
One of those mini numbers that I don't need to remember, but it's
yes,
there.
Yeah, you got your cheat sheet.
Exactly.
When you're in your tax files, of course.
Yeah.
Okay, that's great. And then the last bucket and big takeaways you said from your perspective were 1031 and then cap gains. Tell us a little bit about what happened there.
I actually want to take a step back real quick.
Okay.
So back on the SALT,
Yeah.
state and local taxes, if it's a rental property, you can still offset all of the taxes. So if it's $50,000 worth of taxes, and it's really high,
Yeah.
and maybe you have a big property, but you can still write off the income. So that's still there.
Great
The more,
distinction.
there's no limitation on the mortgage interest for the property. This is all basically primary and secondary homes, and it's on the individual return itemizing.
Great distinction.
Yep. 1031 exchange. I mean, like you said at the very beginning, it doesn't matter where you're politically wise. Trump is a real estate guy. It's a real estate thing. It most likely wasn't going to go away. So yeah, it's still, you can still utilize it. It's just basically, so a 1031 exchange is just essentially selling a property, and normally you have capital gains on it. It's just deferring that tax later down the road. It's for investment properties, not for your primary or secondary.
Yeah, and I think for real estate investors, that is a very valuable tool, hugely valuable and often utilized. Where, in a real estate transaction, you use a 1031 intermediary and they help execute the transaction. And as you said, you're not exposed. Whatever your gain was from that sale, it's basically rolled over in a like-kind purchase. And that cap gains is sheltered. And then when you go to sell that property, if 1031 is still in play, you can 1031 it again. Or if you're just looking to take your chips off the table, then you would be exposed to the cap gains tax at that point in time.
So it is of like value, like kind. So it's residential, go up to like an apartment complex or something like that. But it's to fully defer the entire gain, it'd be the sale. Sorry, I don't want to get too deep into this, but it's the same value or greater.
Yes.
As to what you're going to defer. You may want to buy. You don't have to do the whole thing. You could do part of it. You could do part of it as a gain and part of it as a 1031 exchange, and you could push off the remaining to later years. But yes, you can continue to do a 1031 exchange over and over and over, as long as it's the same value or greater. If you're wanting to get rid of all of the tax, you can continue to do that forever until.
And that's a great wealth building tool. And of course, if it's a rental property, you have your annual P&L and your annual rents and expenses, of course, but you ultimately are rolling forward that equity effectively, right? Until you have the tax of liability.
Yeah. So sorry, I was going to try to piggyback off something here too. Real estate is really kind of a cool, I call them buckets of income, because like for it's a rental property, you've got a few things. You've got the rental income, cash flow every month, better big cash flow in each month. You got depreciation, something the government just gives you for investing in property. And then you got something outside of taxes that normally appreciates in value. And so you got those three combined things. And so it's a cool bucket to have your income in. Yeah, back to the 1031 exchange. It's just you sell the property, move down, sell the property, move down. And let's say you get to your end of life scenario, you still own it. You pass away, you hand it over to your kids, and they currently what they get is a step up in basis. It's essentially you may have bought the house at $100,000, and now when you die, it's worth $3 million. Okay, well they get what is called a step up in basis, step up in cost, and so on the day you die, it's the value. So instead of their value being $100,000, it's $3 million. So they could sell it right then and there without any capital gains.
Wow.
There's a lot with that you can play around with. That's very unique to each individual. But
yeah, and I think that was a great example and just anecdote for why real estate is and can be a real generational wealth creation vehicle, right?
Yeah, and it's that, and it's also really hard. Like if you just have, from my perspective, it's really if you just have a W-2 job and that's all you have. Like just say you're just single guy working your job and you have whatever it is. It's just a job, W-2. There really isn't much that I or any other tax professional can do for you. You start shifting your money from that W-2 to real estate, to a business, to other investments. You get more. You get more tax benefits. Because ultimately, the tax code is just a kind of a book of what the government wants you to do. Mm-hmm. The government wants you to invest in real estate so they can provide homes for its population. Mm-hmm. Short answer,
Yeah. And great example of why having someone like Logan in your network can be very strategic, help build some vision and roadmap planning to shelter your money and leverage the tax code.
Yeah. But back to your question, real estate it's very unique. It's within our tax code, and it's definitely not everybody is into real estate, but it's probably a primarily real estate viewership here. But if it's for you, it's a great place to put your money in and do it. And you can definitely, with those few things that I mentioned earlier, you definitely can create some wealth that you can't do with anything other things. So it's a good place.
Yeah, good. I agree. So let's then talk about the last item you mentioned, cap gains on personal residence. Yep. I think that was relatively unchanged, but what can you share about that?
That didn't change. The rate, the brackets changed for inflation and things like that. But for your primary home, you still have the cap gain exclusion. Single, it's $250,000 exclusion. Married, filing, joint is $500,000. So you can exclude $500,000 of gain, which actually is becoming more, like around here has been a common issue.
Yeah.
Definitely in the last few years. There's definitely been a few that I've dealt with that have run into having to pay it because the gain is more.
They've exceeded that 500 or 250.
The capital gains taxes start. It's I think 0% is at up to I think $48,000 for a single and $96,000 or $7,000 for joint, and then I think it's 15%. It's between for single it's 48 to 500 something, low 500, and then joint is that 96 to 600 something, and then so anything over that is the 20% capital gains tax.
Okay, and that's just the federal tax.
That's just rate, federal. Right? Yeah, this is only federal, and so you have the 0, 15, and 20%. And that is just capital gains taxes. There's other taxes,
federal, and then you would add on state. As you said, people who bought during COVID, pre-COVID. In Steamboat in Marienau County, there's a moderate likelihood that they've already exceeded that $500,000 appreciation limit if you're filing jointly.
One thing I just forgot to mention though is that you pre-COVID, say 2019, whatever, you have this huge gain on your primary. If you bought it in 19 and you sold it less than a year later, that's not the 0%, 15 or 20%.
Yeah.
That's short. It's ordinary. It's a short term.
It's short term.
Yeah, long term and short term. Long term is anything over a year. Short term is less than a year.
Great distinction.
And short term is ordinary income. So it's at your normal, ordinary income brackets, wherever you sit on there.
Yeah.
And
that's going to be a higher.
You could be up at
higher tax rate.
30 something, 37%, and then you have the state income tax as well. So you could be paying 40, 50%.
Yeah. So there's certainly some. Strategy. I mean, right now we're not seeing that volatility or fluctuation in the market, but
the people that probably with real estate stuff that probably get hit with that is the flipper. They're buying a house and flipping it.
Sure.
I mean, but at the end of the day, now they're a real estate professional, and so they get back to the benefits they got earlier. Benefits. So it's again, you gotta look at your situation. Yeah. But it gotta be really careful. If you're just investing in property, you think about long term type stuff. Yeah. It should be a long-term thing.
Okay. All right. Awesome content there. Covered a lot of important topics and real estate nuance coming out of the One Big Beautiful Bill. So, Logan, one of the last questions that I like to ask my guests is if you had $1 million to invest in Steamboat or Marienau County real estate or in a Steamboat or Marienau County business, how would you invest that money and why?
Yeah, for sure. So, $1 million. So, I have a little bit of real estate myself, and then I have my own accounting firm, and so I would probably pair the two together, take the $1 million and leverage that with a loan, and buy, say, a $3 million property or something like that, residential property, and leverage what we've talked about, taking the bonus depreciation, possibly getting a cost segregation study, and taking the most I can out of that in that first year, And then obviously if there's losses, to offset my other business income and things like that. But yeah, it'd be in that residential real estate world, combining with my my accounting firm and other businesses. So.
That's practicing what you preach seems like a no-brainer, and a great way to leverage everything that we talked about here today. I'd probably do something similar. Good stuff.
Yep.
Well, thank you so much for being here.
Awesome.
And again, we're going to have contact information down in the comments, so please reach out to Logan.
You can definitely reach out to me at marienautax.com or Logan at marienautax.com.
Awesome. All right. Well, thanks a lot for your time. Appreciate it.
Thank you.
All right. That's a wrap of episode number 4 of Steamboat Real Estate and Investing. Big thanks to Logan for all of his valuable information and knowledge sharing on 100% bonus depreciation, the new SALT limits, 1031 exchanges, and the cap gain limits, as well as some other tax information. If there's one big takeaway from today's episode, it is 100% bonus depreciation. It's 100% a big deal and a powerful tool. Remember, if you're interested in learning more or utilizing bonus depreciation, consult with your CPA, tax professional, or attorney. Make sure you have a full understanding of what you're trying to do and validate that you can actually do it. There's a lot of nuance there between the active losses, passive losses, so just really vet that plan. If you want to brainstorm with me, happy to hop on a call or trade some emails. If you'd like to connect with Logan, his information is going to be linked below. And we're going to jump into a quick Steamboat market snapshot. Running through the numbers, year-to-date average price per square foot in Steamboat right now is $804 a square foot. That's down 3% from 2024. Year-to-date median sales price in Steamboat is $1.25 million, also down 3% from 2024. Year-to-date median days on market in Steamboat is 22 days. That is up 83% from 2024. Year-to-date listings sold in Routt County, it's 289 listings. That's down 4% from 2024. Total year-to-date sales volume in Routt County is $479 million. That's up 1% from 2024. Pending listings, as of August 1st, we had 117 pending listings in Routt County. That's up 8% from last year. And active residential listings, as of August 1st, 424 listings. That's a lot of listings. More than we've seen over the last few years, and up 58% compared to last year. With this big jump in inventory, buyers have more leverage and negotiating power than they've had in years, really since before the COVID boom. Many sellers have been slower to adjust their pricing down, which is driving those days on market higher. But well-priced homes are still moving quickly. Just last month, I closed a beautiful cabin in Steamboat Pines. We closed it at 99% of list price, with a cash offer just below $3 million. So as long as you're pricing right and you've got a good product, there are buyers out there. If you have questions about today's content or the Steamboat real estate market, reach out to me at ryan.cox@steamboatsir.com. That's going to be linked below as well. And if you or someone you know is interested in buying or selling real estate in Steamboat and surrounds, please reach out, ryan.cox@steamboatsir.com. If you found value in today's episode, please subscribe, leave a review, or share it with a friend. Thanks so much for tuning in, and I will see you next time. Have a great day.